Good morning, everybody. May 3rd, and this is the weekly wrap for members, where we take a look at what happened last week and how that played out. Did it play out according to what we thought? Are we seeing the sorts of evidence that would suggest that we know what we're doing? Do we need to change anything? And as you know, last week I talked quite a bit about the need for us to forget the domestic markets for the most part, unless they were core trades, and focus our attention on the currencies and the indexes associated with overseas markets, because that's where the money is right now. And we really need to trade those markets as they consolidate themselves, because they have good support underneath as a result of what's going on. And it just increases our odds, right? And that's what it's always about. So, last week, U.S. markets were under pressure for most of the week. Got a big bounce on Friday. We actually, did pretty well as a result of having a small footprint and then making some purchases Friday, Thursday, and Friday, right? That made a nice a bounce. So overall, down. The big one, of course, was the Russell, down 3%. We're going to talk about maybe why that's the case. On the year, still struggling, but still up. These markets just don't want to go down. So it's not a horrible story, but at the same time, it's kind of a tough sell, so to speak, in terms of getting these markets to rise. If we look at what's happening, right, from a technical and fundamental picture, the Europe, extended lower, but it looks like they're trying to put in that bottom range. So let's look at that together. Now, they didn't trade Friday, so it was May Day, so we don't know exactly if that's the case. But last week we talked about the probability that this would come back. This is the CACs. So the French market would come back, would test into this swing point high, bullish retest region, and because it's more than 6 bars, right, and the first time back, right, more than likely this thing will get a bounce. Now, we held barely. We attacked it though with more volume, which is not good, which suggests that this really is a consolidation range, and that we have to expect, if we look at this on a larger term basis, we have to expect some sort of a consolidation is going to take place, and I wouldn't be surprised to see it expand before it's over, to where you have this kind of two areas right inside this larger consolidation that's probably going to expand as we go forward. So that's the main takeaway this week, is that given the action that we've seen, more than likely this consolidation is going to expand over time, and we're going to want to be aware of that, which means that we want to flip into any kind of bounces on any kind of purchases that we make. That also is echoed in the German market, where it traded down just like we thought it would, broke these swing point lows, traded lower, also will bounce off of what's happening in France. Now, if we look at it on a weekly basis, it came right back into a support zone. I think it's already done kind of that, consolidation that we thought would take place on the wider range, right? So you kind of got these two areas here again. And so it's already done that. Now, when it bounces and comes back up to test this area, that will be the area probably to sell, and to look to see how it trades when it comes back down, if in fact it plays out that way. So in other words, does it trade here, or does it expand as well and put in some sort of a consolidation back into this bar? And that's probably what it's going to do. Now, if all of this plays out that way, there's opportunities for us, and those opportunities, of course, are to take these pullbacks, right, where you have strong support, buy them, right, just like we try to do here, flip them into the strength, and then try to do it again, right, either here or down here again. Why do we want to do that in these markets? Well, because these markets are the strong ones, right? They're going to have strong buying support on any kind of consolidation expansion once it expands. just like it probably has happened here on this end of the week last week. So we'll see if it plays out that way, but there's other evidence that suggests that in fact that is more than likely what's happening. So as far as other evidence, the big thing is the euro, it's the currencies. The euro we thought would probably fell as it came back up into this area. And so as we look at, on a weekly basis, as we look at the euro, this little zone right here looked like a key area that's probably going to see the euro fall back down, right, and fell on the test. ABCD structure in place, right, has basically completed on this time frame, more than extended on the daily time frame. If we go back to that, a nice extension here, ABCD structure up. This thing has completed more so than it should. Swing point highs broken, expansion on that stops, right? These were more than likely what you saw here was stops off of these triggering right there on this expansion bar. A little bit more push. Now what do? You go over, under, 2-bar reversal, lighter volume, right? Extended move into a bearish retest region on this time frame on the daily. So this all looks to me like the euro wants to come back, and if that's true, that should put some juice back into the equity markets, and we should see that happen this week. And so the fact that we bought into those, we should get that bounce, we should sell into that bounce, because what is this going to do? It's going to come back and it's going to do a bullish retest region on the euro itself. As it comes back into this area, that will be the key, right? Big bar up, breakout, right? The test will be right here. And so we want to take advantage of what it's given us, and then see what the bounce looks like if it bounces off of this area. If it doesn't, right, then this was nothing but short covering, this whole move, and that we're really off into something else. And so that's the additional information that's out there that's suggesting that more than likely that move in the European markets really is going to take place. Elsewhere, there's talk of more stimulus in China. And if you look at our markets, our markets basically followed the European markets around all last week. And the only, big move they got was when that euro finally failed, right? It stopped pushing higher, and that's when we got the spike back up in our markets. So low volume spike back up. This looks to me like it's going to come back up, and it's going to try to test back up into these highs off the European bounce, although we've already made the big bounce, right? If the Europe just catches up with us, then we kind of try to drift up. But as we just saw in the euro is going to come back just a bit, do a retest, and then we'll see how it behaves and what happens here. So we got to bounce off of them. If we look at the positives, that 2-bar reversal, the takeaway bars on Friday, which we just looked at, right? So these were takeaway bars. You get a big move down, volume expands, and then you come back the very next day and take away all the badness. And then the other thing that was interesting last week was the Russell. Now the Russell sold off hard, volume expands, breaks a bunch of swing point lows. But if you look at it on the weekly, it's just coming back to do the retest regen on this prior high, although this is the second time it's done this. Did it here once, right? That push back in does have volume, that's a negative, but it does look like it's going to hold for now, and we're going to get a bounce out of the Russell as well. One of the questions, of course, is why is the Russell so weak? And I think that has to do with the economics, and we'll talk about that in a second. The negatives, this market at best is just trading sideways, U.S. markets. And we're doing that elsewhere too, consolidation. The only place that isn't doing it yet is in Asia. They still haven't entered the consolidation phase. The structure for a large decline is in place, and this is the main thing we have to be concerned with, and one of the main reasons we want to keep a small footprint going forward until either this changes or actualizes, one of the two. And what I'm talking about, and let me bring up the S&P again, is that you have a situation now where there's a lot of swing point lows all clustered together on this daily time frame. If it starts to break these, right, that's going to propel it lower, especially if it breaks down here. Now that's on the daily. If we look at the weekly doesn't have any swing point lows at this higher level, right? There's nothing here yet. But if we go a little bit farther, in other words, if this goes out another week or two, we will. And so in other words, we'll set up a weekly swing point low that's in conjunction with the daily swing point lows, which could propel us down to this next area where the swing point lows lie. So in other words, if we go another week, maybe 2 weeks, and we can't push higher, right, then we're going to end up with another swing point low right here. And now a break of this area would push us quickly back to these two swing point lows. And then if we mill around in this area for a while, a break of this area would then be a break of multiple swing points, multiple time frames, daily and weekly, which could push us fast back down towards this area where the swing point lows lie on the weekly. And those swing point lows happen to be now where a swing point low has developed finally on the intermediate term time frame, right? You have them down here on the monthly, on the long term time frame on the monthly. So in other words, if we get the cascade lower here, which cascades us lower into that one, which cascades us lower into this one, right, then you can see you have the structure for a very large decline. One of the members was pointing out to me on Friday that these are all within about 11%, right? This whole area is about 11% top to bottom. So in other words, you only need 11% decline to actualize potentially a very large decline. And, again, it's not present, it's present. It's a necessary condition for a large breakdown, but it's not a sufficient one. In other words, it has to start happening. We have to start seeing on a short-term basis, we have to start seeing it apply. And then if it does that, right, here, if we get the breakdown here, then we have to see if it's going to break down here, which could lead to the more serious breakdown of these lows down around 1800. Now, we're still at 21. It just seems like a long way to get down here. But if it does, folks, right, you could get a very large decline. And that's what we have to always be careful about. So not there yet, but it's just something to keep, in your back pocket. Large declines could be setting up. Fundamentally, there's really not much that's positive. The negative to me is the world growth continues to slow, and it's not just the U.S. In other words, the U.S. keeps blaming it on the dollar. The dollar's what's doing it. Well, maybe the dollar's doing it, but it's doing it to the whole world. It's not just us. And I'll talk about that here in a second when we get to the economics. The big thing for me this week was the reversal in the euro for real. Either they were closed, thin markets. Let's see if it's for real. We'll know that early this week. Bonds. Are the bonds really going to bottom here or not? And this is a big question, because bond markets and currency markets are much larger than equity markets. And when they start to move, if they start to move in larger ways, they have drastic effects. So in other words, if this market can't hold, right, and we start seeing a breakdown of this, and I don't expect it because you got a huge volume down there. It looks to me like it's going to come test it and probably bounce off of it. But that 20-year note, right, you're getting interest rates going up, right, and you're getting a sell-off in the bonds themselves. You're coming down to test that spike low. If you look at it on the weekly, that's the low here. If it gets under it, the big test is down here at 120.05. It's not the end of the world yet, but if these bonds really do start to sell off, right, then that is a problem for equity markets. In other words, if these start to cascade lower, right? That's going to be an issue. So it's something to keep on our mind. Again, this could play into what I was just talking about with the actualization of those swing point low breaks on the equity markets. So again, something to watch. I expect some sort of a bounce out of here to start with. We'll see if it sets up lower. I never like the pattern that sets up like this, where you come down, you bounce around, and you come back down, right? Kind of like an H. That pattern is not a good one. And so, and it's basically, it's the same idea that we have with ABCD structures, right? So you gotta, in this case, it's from here, you get the bounce now, and it's actually interesting because now the way it's set up, it actually comes down to test this low. So it may be that we're setting up to test this low and then eventually get the next move higher. But you know what? We just have to keep an eye on it because right now it's setting up kind of a more dangerous structure to go lower, and we'll have to see how it plays out. And so I want to see if they bottom, get a bounce. If they do, I think equity markets probably bounce. Upcoming economics, I've kind of put this in a different format. It's easier for me to put it out here. What I do is I take, the ones, that you can get to all this data yourself, but I take and throw them in here, and I cut out the ones I don't think are that important and keep the ones that I think are important. Main thing this week is the rest of the earnings basically are going to come out. So this is the last big week of earnings. We're going to get a lot more reading on the world economics. The Fed meeting's done. They didn't do anything, didn't change anything, but they're going to get out and start talking again like they always do the week or two afterwards to tell us what they really said, which tells us nothing. It's just a bunch of crap. But anyway, they're going to be out there talking and they can move the markets. If we look at the data that's coming out this week, you get a lot of PMI numbers. These are kind of forward-looking numbers. Those are surveys basically saying, okay, what's the most telling numbers that we have right now. So we got a lot of data this week that's going to give us a lot more hint about what's coming on. And I want to talk about that because one of the things everybody keeps pointing to is that, oh, this is just like last year where we had a bad winter and then things got better. Well, let's look at last year, right? Here's October. So you get a nice big push up, right, from the weakness at the beginning of the year, and this was beginning of 13, not 14, right? Push up, and then what happens? It just collapses in January, which was the winter weather of 2014. And then what happens? Oh, a nice recovery, nice big push, new highs. But then what happens? This looks very different now. And what I'm talking about, what I want you to focus on is look at how it looked last year, and then all of a sudden you got a sudden drop on the winter bad weather. Now, look at how it happened last year, right? Kind of tops, and then what happens? This is not winter. This is selling off all through October on. That's a very different picture than a fast drop off of bad winter weather. This wasn't bad winter weather. We didn't have any weather bad. We didn't have it here, right? We kind of had it down here, but we were already declining. Are we going to get the big recovery? I don't think so. Maybe we get some, but I don't think we're going to get the big recovery. And it's not just here. It's pretty much everywhere. If you look at, the PMI number, it was within the range, so that was good. These numbers I was just showing you here, these basically were the ISM, and I guess I don't have the numbers, but anyway, the ISM numbers came in worse. If you look at the actual manufacturing employment component of this, it went negative. So it's not even expanding anymore. If you go to the international numbers, look at the PMI that came out last week on Japan. Negative, right? Contraction. If you look at it in Great Britain, they expected 54, they got 51, right? Much worse than expected. This is happening pretty much everywhere. In other words, we're seeing contraction around the world. It's not just here. And it's not just the weather, which everybody keeps thinking it is. And I believe this week we may see that, more evidence of that. I expect some sort of a bounce, but the real key is going to be next month and the month after. right? If those numbers really don't come in stronger and we get that strong rebound that everybody thinks we're going to get, then everybody's going to start to question it, and that's when we're going to see the effect. So you just had earnings not good, can't expand the revs, right? If the economics around the world really are softer, they're not going to expand those revs. Those earnings numbers are going to have to come down. It's going to put more pressure on this market. Okay? So that's where that is. And, really, that's the bottom line. If the economics don't support the conclusion that it was just the soft winter, from a bad winter, a soft patch because of the winter, then we're going to see more pressure. I expect that's going to be next month, not so much this month, because you'll probably get some improvement, and everybody will think, okay, we're going to rebound strong. As a trader, the focus is to find those places where strength is there and probably is going to continue. And as I said last week, I think as this market gyrates, we don't want to be in most of the domestic names. We want to be in international names where there is good strength. And I think that one of the things that's finally changed is that we actually can hold short positions finally. And so I'm not so scared of those as I have been, because I had abandoned short positions, 2 years now? A long time. I hadn't even put them in here. If you look back, I think it's been a good year and a half, 2 years. Portfolio. Last week I think I touched on exactly what I thought we should do. I started doing it this last week. So I'm kind of repeating what I said there. I began to shift my focus almost exclusively to overseas. The summary, we took out a couple names last week on some bounces, actually one on a stop, one on a bounce. And we're slowly shifting to more of exactly what I'm talking about, and that is look overseas. So if we look at some of these names, and I'll go through some of these, we took some positions that allowed us, a possibility of some gains. And we took those on post-earnings plays prior to, my focus last week was to get away from this and kind of leave these and try to trade consolidation ranges on strong indexes and ETFs overseas. And so anyway, NTRS, got a nice big bounce off of earnings, pulls back. We bought the pull back. Now we get, kind of consolidation last week. It's going to try to attack this bar again, 71.93, 73.87. I'm going to try to sell into it. Take profits. I'll take the 1.5% or whatever it is. I think we have to do that pretty much across the board in all these all these US positions and trade elsewhere. AYI is another one. It's the exact same trade. Got a nice big spike up on Friday. It's going to try to come back up here and test this area. Want to sell into it, make the money. CarMax, we kind of got stuck in. This one didn't trade very well. Actually came back, closed the gap. Knew it was a possibility. We took a smaller position as a result of it. As this comes back in the bottom of this bar, just want to leave, right? We'll get almost all our money back if we can, and just get out of it. There's no reason to be in it. Now Starbucks, I actually added this week. I think it's a core position. Starbucks closed the same ideas, closed the gap, big strong earnings. Coffee prices look like they're about ready to cave in, which means their cost of goods is going to go down, which will counter any kind of negativity on the dollar itself. And growth-wise, they're one of the few companies out there that's growing great. So they came into this big bar, no volume. That looked like a great place to buy. We were fortunate and got in it on Friday. Want to sell as it comes back up to test the swing, what will be a swing point high probably by the time we get there. But the earnings bar spike, and we'll sell its core position. So we'll sell half of it, try to buy it back lower again as it consolidates in a higher range. And that's the ideal on almost everything. So if I switch over to like HEDJ, we bought this one. This is the European hedge. Get a bounce, sell into it. If we look at the HEWG, if you remember here, we actually sold this bounce, right? pick it back up lower, try to sell the next bounce. On and on. It's going to be the same across all of these. DXJ, we actually got, and I believe this one's going to consolidate more. We got a spike down. We're able to buy the spike. Got a nice big pop back up now. Volume into that retest region, right? First time back, 2 for more than 6 bars. So this was actually an ideal case to buy. So you got a retest region here, another one there, spikes into it right after more than 6 bars, get a bounce out of it. What is it doing? It's going to come back and test this little high and potentially test back into this top. What do we want to do? We want to sell into that spike and then look to buy again, either here or potentially even lower, because this could be setting up a larger consolidation range, right? It could be setting up this larger consolidation, in which case we might want to buy it lower. But we don't know that. For all we know, it may set up another high. That's why you sell half of it and you wait, because you don't know which one it's going to be. But what you do know, and the reason you're playing it, the reason we've trying to switch our attention to these, is it's got a very strong, young move still going on. I don't know if it's young, but we've got, these markets have something behind them. What is that? Central banks easing, devaluing the currencies, driving the positions higher. If you buy the hedges, you're going to get hurt by the currency devaluation, and you get the push. That's the whole idea. Let me see. Anything else? Oh, docs. All right, so I want to go over a couple more. We're going to try to leave this. They reported earnings. Earnings were okay. Big bars, though. I don't like that situation. Getting kind of bounced. Just get out, take our money, and then put it back on a watch list. NXPI is an exception. This one actually had earnings. Drifted around down here, held, got a nice bounce off. We'll want to sell into a spike. And again, this is one we can continue to hold because it continues to act right. And then lastly, let's look at Zeltiq. Zeltiq has earnings Tuesday after the bell, I believe. You've had some big spikes down. That makes me nervous. I want to sell any strength up into the 32 area, right? And then wait. Whittle our size back down to something small and see if this is going to hold this higher range or if it's going to expand it. Given the bars that I see on the daily, it may expand it. And if it expands it, right, I want to be buying this area down here. This is the key area. And so we just make our position very small in case we're wrong and it expands to the top side. But if we're right, and if it breaks down here, then we potentially can pick it up a lot lower. Okay, well, that's the ideas. That's this week. That's where we're at. As always, I thank you. If I can help, give me a holler. That's it for the week. Take care of yourself. I'll see you as the week goes on.